Ever feel that knot in your stomach when you see the stock market plummet? News channels are screaming, charts are a sea of red, and it feels like the financial world is ending. We've all seen the images of panicked traders, but have you ever noticed who seems to stay calm amidst the chaos? The wealthy? It's like they have a secret playbook for market turmoil. What do they know that the rest of us don't? Is it just that they have more money to lose? Or is there something deeper at play? Today, we're pulling back the curtain. We're going to break down the exact strategies the wealthy use, not just to survive, but to thrive during market uncertainty. This isn't about luck, it's about a mindset and a set of rules that anyone can learn. Stick with me, because by the end of this video, you'll have the framework to build your own financial fortress. So, what's the first and most fundamental secret? It's surprisingly simple. They play a different game. While most people are glued to their screens, reacting to every daily tick of the market, the wealthy are looking at a much, much bigger picture. They're not investing for next week or next month. They're investing for the next 15, 20, even 25 years. Think about it like this. If you're planning a cross-country road trip, you do want to panic and turn back every time you hit a small pothole or a patch of bad weather, right? You know, it's part of the journey. The wealthy view market dips in the same way. They are just potholes on a very long road to their financial destination. History shows us this time and time again. Look at any long-term chart of the market. You'll see wars, pandemics, recessions, and all sorts of crises. Each one felt like the end of the world at the time. But what do you see when you zoom out? A consistent upward trend. The wealthy understand this historical context. They know that markets are cyclical and that periods of decline are always followed by periods of recovery and growth. This long-term perspective allows them to detach emotionally from short-term noise and avoid the biggest mistake an investor can make: selling in a panic at the bottom of the market. They've set their destination and they trust the process to get them there. Now, having a long-term vision is crucial, but it's not enough on its own. You can't just throw all your money into one thing and hope for the best over 30 years. This brings us to the second pillar of their strategy: radical diversification. You've probably heard the old saying, don't put all your eggs in one basket. Well, the wealthy take this to a whole new level. They don't just own a few different stocks. Their portfolio is more like a well-stocked supermarket with many different aisles. You'll find a section for stocks, of course, but it's broken down into domestic, international, large cap, small cap. Then you have another aisle for bonds, government bonds, corporate bonds, municipal bonds. Then you have a whole section for real estate, from residential properties to commercial buildings. And over here, you've got a section for alternative investments like precious metals, commodities, and maybe even private equity or venture capital. Why go through all this trouble? Because different asset classes react differently to economic conditions. When stocks are down, bonds might be stable or even up. When inflation is high, real estate and commodities can perform well. It's like building a team where each player has a different skill. A loss in one area of the portfolio is often offset by a gain in another. This creates a much smoother ride and significantly reduces overall risk. It's this careful balance that prevents a market crash in one sector from wiping out their entire net worth. So, they have a long-term plan and a diversified portfolio. But what about when the market does take a nosedive? This is where the real magic happens. And it's all about one word: liquidity. While everyone else is forced to sell their assets at a loss to cover expenses or meet margin calls, the wealthy have been patiently building up cash reserves. They see cash not as a boring, non-performing asset, but as a strategic tool. It's dry powder. Think of it like a financial war chest. When the storm hits and fear is rampant, what happens? Asset prices plummet. Stocks, real estate, entire businesses go on sale. This is the moment the wealthy have been waiting for. With their cash reserves, they can step into the market and buy high-quality assets at a massive discount. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is the perfect embodiment of that philosophy. A market crash, for them, isn't a crisis. It's the biggest shopping opportunity of the decade. They're not just surviving the downturn, they're actively using it to plant the seeds for their next wave of wealth creation. While others are selling out of fear, they are buying with conviction, knowing that the assets they acquire at bargain prices will generate enormous returns when the market eventually recovers. This ability to act decisively during a crisis isn't just about having cash, it's about having the knowledge and confidence to pull the trigger. This leads us to the fourth key habit: continuous learning and information gathering. The world's most successful investors are voracious learners. They're not just watching cable news, they're reading annual reports, industry journals, history books, and economic analyses. They're constantly trying to understand the deep, underlying trends that shape our economy, not just the surface-level headlines. They know that knowledge is the ultimate antidote to fear. When you understand why the market is falling, whether it's due to interest rate changes, geopolitical events, or a technological disruption, you can make rational, strategic decisions instead of emotional, reactive ones. They're not trying to predict the market's every move. No one can do that. Instead, they're focused on understanding the fundamentals of the businesses and assets they own. This deep knowledge allows them to distinguish between temporary market panic and a genuine, long-term problem with an investment. They stay informed not to time the market, but to ensure their time in the market is spent in the highest quality, most resilient assets. This commitment to education is a lifelong pursuit, and it's what separates the amateur speculator from the professional investor. Finally, all these strategies are wrapped in a powerful layer of proactive risk management. Building wealth is one thing, protecting it is another entirely. The wealthy are masters of defense. They use a variety of tools and strategies to shield their assets from unnecessary losses. One of the most common is portfolio rebalancing. Let's say their target is to have 60% stocks and 40% bonds. After a great year for stocks, their portfolio might drift to 70% stocks. A disciplined investor will then sell some of those stocks, taking profits off the table, and buy more bonds to get back to their 60-40th target. This forces them to sell high and buy low automatically. Another key aspect is tax optimization. They work with experts to structure their investments in the most tax-efficient way possible, using accounts like Roth IRAs, 401ks, and trusts to minimize the tax bite and allow their wealth to compound more effectively. They might also use sophisticated insurance strategies or legal structures to protect their assets from lawsuits or other unforeseen liabilities. The key takeaway is that they don't just hope for the best, they actively plan for the worst. This defensive mindset ensures that a single bad event or a market downturn does derail their entire long-term financial plan. So, let's bring it all together. What have we learned today? The secret of the wealthy isn't some magic formula. It's a disciplined, systematic approach built on 5 key pillars. First, they maintain a long-term vision, focusing on a horizon of decades, not days. Second, they build resilient, diversified portfolios that can weather any economic storm. Third, they maintain liquidity, turning market crises into once-in-a-decade buying opportunities. Fourth, they are committed to continuous learning, making decisions based on knowledge, not fear. And fifth, they proactively manage risk, protecting the wealth they've worked so hard to build. It is a powerful combination that allows them to remain calm and act rationally when everyone else is panicking. The ultimate lesson here is that financial success isn't about avoiding the storm. Storms are inevitable. It's about building a ship that is strong enough and having a crew that is skilled enough to navigate through it and reach the other side stronger than before. Thanks so much for watching. I hope this gives you a new perspective on how to approach your own financial journey. If you found this valuable, please give this video a like and subscribe to the channel for more insights on building lasting wealth.